welcome to our first live stream for Buyer. It's been a few months since our amazing conference, and we wanted to do a few targeted live streams around topics that are going to be impacting buyers agents in 2026. So our first one is going to be talking about finance and the lending space. There's been a lot of media around interest rates, around changes to APRA lending, changes to trust lending, SMSFs. So we wanted to bring in our experts, Sumit from Zinger Finance and Ridwan from One Path Accountants, to have a chat, talk through what these changes are, how is it going to impact you as a BA and impact your clients. Obviously, working in the BA space, we want the best for our clients. We want to make sure that when they're doing the deals, it's the right deals for them, that they can get the finance to set them up to purchase the next property and to build their portfolios. So let's get started. Welcome.
Hi, Ellie. How are you?
Good. How are you?
Good, thanks. How are you?
Good, thank you. So I think we should jump into APRA first, because that seems to be the biggest thing. We've seen this before back in 2017, and it was almost like the tap turned off with lending for a lot of people, particularly in like that over $1 million budget range. So what are you seeing? How do you think this is going to impact 2026?
So, it's very similar to 2017 and 19, where they came back and they were like, okay, DTI restrictions is implemented now and all those things. So we need to understand why the regulatory bodies do these kind of things. So they have different tools. APRA has serviceability restrictions where they can let the banks have a floor rate. So they took it back and provided it to the banks on 2019. The other one is the buffer rate. So it used to be 2.5, they increased to 3 in 2021. And some other kind of restriction could be LVR restriction, which is loan to value restriction. In Australia, it's more about, like, we haven't seen anything where it's restricted through APRA or regulatory bodies, but it's more like a bank's restriction in that space. Okay. And the last one is a DTI restriction. So my take on that is DTI restriction is more to make sure that the property value doesn't go crazy, because if you look at the supply and the demand, supply is constrained, demand is increasing because of the high immigration. The dependency ratio for Australia is projected to go up. The fertility rate is down, so immigration is the only way to bring in people so that they can have in future low dependency ratio. So what's happening is, with government coming in with those first home low deposit scheme, no LMI, they remove the cap of the income, they remove the number of people they can provide those facilities, because they used to have those kind of cap before last year. So it's very much like pushing the demand up. So the only way for the regulatory bodies to make sure that the property value doesn't go crazy is putting those kind of restrictions. And it's very it's not restriction in regards to a total restriction, it's a allocated restriction. It's 20% of the bank's book. So let's say if your income is 80K, so if they can give you up to 6 times, which is, they have placed it at DTI at 6, which is 480K as a loan amount. And that doesn't mean that they won't lend to anyone else who have DTI higher than 6. But if their book has that space of 20%, then they'll still lend it based on different factors. But if their book is pretty much like 20% for that quarter or that year, then they won't lend to the clients who have DTI more than 6. So the space where we need to be careful is if you have a pre-approval, and then if you're looking for a property and you have got a pre-approval from a specific lender where your DTI was higher than 6, if you haven't found a property, and if you found a property and going back to the bank at that period of time, they might still reject it even if you have a pre-approved, because their DTI might have already gone up to 20%.
In that time frame.
Yeah.
And that would impact the off-the-plan space as well. Yes, I was selling off-the-plan land, and we had clients who had received pre-approvals pre-APRA lending changes, and then come post, when they came time for settlement, the banks weren't able to lend on their properties.
That's a big risk.
Especially, so because we had some clients that went to second and third tier lenders.
Yep.
So is this mainly impacting your top four?
Yes. So it's implemented to ADIs. It's like authorized deposit taking institutions. So there's somewhere around 123 in Australia. So it's not
Okay.
impacting the non-bank lenders like second tier or third tier lenders.
Sure.
They are not impacted by these specific policies. I've had chat with a couple of our BDMs. They are predicting a lot of flow in their space. So they are hiring more credit people so that they can accommodate those investors and people who wants to borrow and keep growing their portfolio.
Okay.
Yeah.
So really, this is about having brokers who understand and who are in your corner. You wouldn't really be recommending clients to go direct to bank
Yes.
in these kind of circumstances?
Yes. So if you go to the bank, like you might get a pre-approval, right? Then like with bank, they only know one bank's policy. What if when you got the pre-approval and when you found the property, the allocations for the bank has like reached to a maximum 20% and they reject you? Then you need to find another solution straight away. And with banks, they might not be able to find you any other solution. That's where your broker come into picture because we understand the policies and like how to get loan through certain lenders or what will happen after few months or few years when you acquire that asset, like how we are going to restructure it.
Yes.
And so
Okay. Do you think it's going to have an impact on the property market in terms of values and
I think
purchasing?
like with investors, especially investors, they want to keep acquiring the properties and assets because they understand that the policy keeps on changing from market to market. So this might be a temporary like last time 1-2 years and so. But if you look at the demand supply, it's saying something else. It's saying high demand, less supply, the price will go up. That's where the investor like kind of like win over the market, and then whoever is acquiring more assets when the like price goes up in future, they are the one who benefited a lot of out of this space. So I think it won't have much impact on the investor side because they would want to accumulate and they understand that the loan contract is for 30 years. Even if second tier has a bit of a high interest rate, they will just be a short-term pain, and then down the line, like they can always refinance for better interest rate when the policies and the market change.
True. And what can, well, obviously we can't provide financial advice as buyer's agents, but what could we be advising our clients to make sure that they're in the best spot when it comes to getting a loan? I remember back in 2017, you couldn't have big cash withdrawals, Uber receipts. Like there were certain things that we were saying to clients, make sure your bank accounts look clean.
Yeah, so budgeting would be one of them, making sure like as an investor, most of the investors that we are dealing with are within that budget. They don't spend much on other aspects, the type of asset they want to purchase, because if you look at it, at the end of the day, it's income minus expenses minus commitment. That's what the bank's looking at, and they put some restrictions here and there, servicing buffer, HEM, that comes into picture. So if you have a high cash flow properties coming in, that will boost up your income. And even for DTI, it's debt to income ratio.
Right.
So the income will include your income from your salary, your income from business, rental income, and the expenses will include all the expenses. That is usually the HEM, because even if you are spending $1,500 as an investor per month, they will have HEM, which is a model based on your income and a number of people in household. They'll take that into consideration, and commitments is all the debts. So maybe not having more like bad debts, car loans, personal loans, credit cards, making sure those are less. You don't make those kind of inquiries, and then having more high cash flow properties will help you navigate around debt to income ratio restrictions too.
Okay.
Yeah.
And what about for self-employed? If we're dealing with self-employed, how are they going to be, like, how can an accountant and a broker help them get themselves in the best position to get loans to service?
Yeah, look, I think from our perspective, from an accounting and taxation point of view, we don't necessarily comment too much about why the banks do this, but we want to know what the outcome is going to be, because clients will sit down with us and say, hey, I am self-employed, is this going to impact me? So if we don't work with the broking team who understands property quite well, and you do more of the same, then you'll get the same outcome. So for us, I think we were speaking about it at the client function, is this is very similar to what you said in 2017, where they're trying to take the heat out of the property market, but not actually, handcuff everyone to high interest rates. So it's like a bit of a balancing act. And I think to what Sumit's point was, is that if you have a broking team who understands, who can work in with your accounting and your buyer's agency well, that you end up looking at these as opportunities. So if the property market comes down, is it a buying opportunity, or is it a point where you refinance to bring in cash into your books? And you might work with your accountant to say, okay, great, I also refinance and do A, B, C, D. Is there a tax implication? So in answer to your direct question, self-employed people, they often have the opportunity to be able to chase down non-bank lenders to be able to get additional servicing. That could be through accountant letters, it could be through BAS forecasting, for example. So it's always good, like we speak quite regularly about, hey, can we do this for a client after we've had a meeting to determine whether or not they can access finance or additional equity, maybe just in preparation for a downturn, right?
Yeah.
So I think that buyers agents who are looking at this period and getting worried about what the banks are doing aren't kind of using history, like that previous historical data that you can get. A lot of the financial models look at what has happened and what happens in the future. If you say to your broker, hey, I'd like to just get ready, like I have clients who are in the share space, and I think the share space is a bit toppy.
Yeah.
They're all getting their margin loans ready. In the event that it does come off, they'll buy. And I think property is similar. So if you're self-employed, it's a great time to be able to get a pre-approval and make sure that your finances look really good coming up. In the event that there is a buying opportunity, go for it.
Yeah. So just getting clients ready, especially obviously we're coming up to Christmas, so things are going to start to slow down. But getting everyone ready to go in 2026 and take advantage of whatever the market is offering. The next big thing, I don't think this had happened yet at Buyer. Maybe it was like a week after Buyer that they started to announce the trust lending changes, which obviously has caused like the cat amongst the pigeons in our space. So can you talk a little bit more to what was and what that looks like now?
Yeah, so the first lender to pull out of that space was Macquarie.
Okay.
Because they had the best policy at that period of time. And like what they used to do is, if you set up trust number one, you can buy up to 4 investment property under trust number one. There was a specific criteria of what kind of trust and so.
Yes.
Like discretionary family trust, corporate trustee or individual trustee, has to be like the shareholder, the benefit and the control has to be within the directors and the shareholders. Can't be any external party. So Macquarie was the best in that space because they used to isolate the trust. If you set up multiple trusts, you could buy 4 properties there, and then that's when people start to utilize it or misuse it to acquire more properties because they didn't do their due diligence properly, and so because Macquarie didn't require any accounting letters or so. They would just go based on what the client is saying. Yes. So they are like, okay, if it's neutral or positive, if the client is saying it's neutral or positive cash flow within the trust, then they will isolate it for servicing. So in that case, what happens is you isolate trust number one. When you go to trust number two, the serviceability resets. So that's why people were marketing it, saying infinity lending and all those things, and we're like, no, there's always a catch to it.
Yes.
And I think that's when the regulatory bodies might have put some restriction, or the lenders are like assuming that there is going to be some restriction from regulatory bodies. That's why they're pulling out of that space. Because at the end of the day, the lenders has to do the right thing by the client. So when you're buying properties under the trust, you need to be careful that if it's not negatively geared because it gets trapped in, not an advice, but like you can speak with the accountant, one can confirm those kind of information as well. So if it's negative, then trust will start to work against you rather than it will work for you. Then after that, Macquarie pulled out of the market. Seaway did the same thing. They didn't pull out of the market totally, but they are saying that they'll only lend to the people or clients who are their existing clients, and they have to be there for 6 months. And recently, Westpac has pulled out of the market too. It's very like we are predicting maybe some other lenders will pull out of the market. But the thing is, there are only limited lenders at this period of time who will do a trust lending. That means less competition, so they might have higher rates, higher fees. Then that again comes to the cash flow. Will it be positively geared or negatively geared? because if the rates are going up, your repayments will go up as well. So your loan is going to have higher repayments. That means it will affect your cash flow negatively. If it's neutral and positive, that's fine. But if it's negative, then that's again out of your pocket.
Yeah.
Yeah, and I think it's very important, but I also think an additional is that sometimes you have to accept the lay of the land as it is and re-strategize. If your strategy is purely built on setting up trusts like hotcakes and buying property after property, you have to look at the downstream effect. If, for example, lending regime changes and they say, well, actually now for your 18th property, we're going to analyze all your trusts, then you might never be able to buy a property ever again,
you're
right?
locked out.
Yes.
You've got a lot of accounting, administration costs, asset renewals. All these things tend to, I think, escape a lot of buyers agents when they're looking at how to actually set up their clients, because they're looking at the deal, and we all understand that, right? I want the deal, I want the next deal. But the best type of client is the one who comes back forever, right? And you don't have to remarket, you don't have to reinvent the wheel to get them. So I think from our point of view is that, the podcast that we were on, we said, hey, if you build a strategy on this, then there's going to be limitations. You can use it to an extent, but if you build it purely, and someone like me, we have clients who ring us and say from their brokers, hey, everyone, don't mind, my broker told me if I use this account and pay $4,500, I'll get a letter, get the financials, and I can go get the lending, and I'll come straight back to you. And I'm like, okay, cool, you can just stay with them, because what's going to happen is you're going to be a tag for a problem that's to come. Right?
Yeah.
So it's not a strategy, it's just a solution for that moment in time.
Immediate problem.
Yeah, right.
Yeah.
So I think at the conference we were talking on stage and we said that the best way to scale your business is to scale your clients, right? And if you can get them more properties, you will do well. And if you're the catalyst for that, perfect, right? So I think you can use all of these bylaws and changes in lending to your advantage, but not build your business on it, right? And if you do, and you do it too aggressively, it will come back to haunt you, right? So I think the changes, are self-regulating. The way that I can see the banks, they're actually doing it themselves because of the marketing campaigns that are going out there.
Yep.
And I think as buyer's agents who come to us, we deal with a couple of buyer's agents, the ones who just have really solid, good, repeatable properties. Even if they are put in a trust, the property is still fantastic, right? It's not buying a property which we get emails saying, hey, can your accountant write a letter to say this property is washing its own face?
Yeah, okay.
But it's not, right? So I think that's the premise behind it, that the acquisition is the best thing.
The property is
it's the best thing.
The other thing is, like whoever has acquired those properties under multiple trusts with those kind of advice. So what is going to happen next is, because there are different kind of lenders, and the right way to do it, how ATO does it, is there's no negative carrying under trust. But there are lenders out there where they will negatively carry the investment loan if they are under trust for a serviceability purpose. And there are lenders out there who won't negatively carry investment loans under trust for serviceability purpose. The difference is if you have a $500K purchase price or the value property with $400K loan amount and $500 per week rental income, it will add back somewhere around like $600 to $1,000 per month in our serviceability calculator in negative gearing section. It's like added back to your income. So like what I can see is once they start to put more restrictions in and when they get rid of that negative gearing with few lenders again, then that will be the end of it, because that will impact everyone's serviceability negatively. Like if you have purchased a lot of properties under different trusts, that will kill your service.
Yeah, and I think it's really good for buyers agents who are watching or tuning in is to, if you know your client's property portfolio quite in depth, you can actually make that recommendation to obviously be qualified by an accountant or a broker. But when you get that positive confirmation back saying, oh, what he said was good, like, hey, don't buy in a trust for this reason, or do buy in a trust for this reason, you get that positive confirmation back. It's a really good goodwill scenario for your business, because you go, okay, cool, I don't actually have to 100% of the time double check, triple check what he's saying.
That's right.
We're all in the same swim lane.
Yeah, everyone, they know what they're talking about.
Yeah, exactly.
Why you're paying the fee. But I want to touch on as well, why would someone buy in a trust? Because obviously there's been so much noise about buying in trusts, and then now lenders are pulling out of buying in trusts. But it can be a good strategy for a client depending on their circumstance. What would that circumstance look like?
So generally, the two main reasons prior to the last crazy period of 2 years in trust setups was asset protection, income stream, and tax minimization, and they still hold true.
Yeah.
So all the conversations we have with clients and buyers agents is like, hey, if you're looking at a trust, make sure these two are the same reasons why you're getting into the property. And the third being a lending, benefit or resetting, that's great. So you might have a property which is like a block of units, for example, or something which is cash flow positive, or something foundational that you don't want to ever let go, or you want to keep intergenerationally. So you say, okay, great, I want this property inside of a vehicle, which in the event I get sued, litigation, anything like that, is still protected, right? And sometimes what you find is that people have trophy assets inside of a trust. Wealthy individuals, they might have trophy assets, for example, but often property owners that we see who build large portfolios, they might say, okay, great, I'm willing to sell all these other properties, but not have this property sold. It could be a block of units, it could be something they have. That to say is just also to make sure that you're not putting in properties in a trust which are going to disbenefit you from a tax point of view. To Suma's point, they could be quite negatively geared. You lose the benefits and the credits in your own name, so it becomes harder and harder to hold that property over the long term. So you need to work out if you've got a family pool or you've got a tax pool which you can actually distribute money to legally, and make sure that your tax minimization policy is correct. A trust can be a really useful tool. And the very last one is that in your absence, that trust can live on. And so if you have, for example, children who have spouses, and those spouses, the divorce rates are 50%. You don't want them to be in a position where they get or lose anything. You can allow them to have the income, but the asset remains in perpetuity for the life of that trust, right? So very useful tool and used extensively throughout, the borrowing and property landscape. Kind of to Suma's point, it's been a little bit misused to be able to just try getting the priority function was the lending, when it should never be. That's just the ancillary benefit.
Yeah. So really, you should just be looking at those. If you've got clients looking at trusts, stick to those two top priorities: asset protection, tax minimization.
With a compensate price and stuff.
Yeah, with of course, but don't look at the lending policy because, as we know, that changes.
And then other things like in New South Wales, trusts can sometimes be very expensive to hold properties in because of land tax. In other states, it's slightly better. So the buyer's agent and or the advisors need to come to the client with an overall picture.
Yeah.
Because if you just buy because it's easy to get lending and then the client gets stuck with an $18,000 tax bill each year from land tax, they'd be like, okay, this didn't really work out the way I'd like, right? And so then it kind of destroys the goodwill of the advisors because they go, well, I didn't know, or you should have known, or that impacts your future purchasing strategy, right? So sometimes it's a case where trust may not be ideal, but the person goes, well, I want it in a trust. That's an okay transaction.
Yeah.
But to recommend a trust and then have a an ancillary problem pop up, that's sometimes difficult to navigate.
That's why you need a good team.
Yeah.
Yeah.
Accountants, brokers, solicitors, and SMSFs. Everyone wants to find a self-managed super fund. What is it? How do you set one up?
I think start with the lending landscape because it's quite interesting at the moment, the products they've got.
Yeah, so with SMSF space, like I haven't seen this before. Before they used to have LVR restrictions to 70% and so, and then recently it has been 80%. But last 6 months, there are lenders coming up with 90% LVR loans with no lender mortgage insurance on the self-managed super fund, which is new, crazy. It's very different because with self-managed super fund, when you purchase a property through bear trust and everything, you can't refinance to release equity, like how you can refinance to release equity under a personal name and then buy more, roll it over, and so you can't do that. So let's say with 90% LVR, it changes the dynamics within the market because the only way to get access to that funds if the client purchases a property is to sell property in future.
Sure.
But at 90%, you can acquire 2 properties instead of 1. Which increases your capacity to build up your property portfolio under self-managed super fund. And there are a few more changes. They have increased the loan term period, some of the lender to 40 years.
Oh wow, 30 years. Has that come in?
Yeah, that has come in. So yeah, that's crazy. So there's
90% and 40 years?
Yes.
Wow, okay.
Yeah.
That's pretty good.
Yeah.
Now there are a few requirements around buying in a self-managed super fund. A lot of people don't realise you can't have split contracts.
Yep.
You can't buy land and build. They're not allowed to do home and land packages.
Because it needs to hold only one asset. There are a few exceptions, we've got a few exceptions for some of our clients and some of our buyers agents where, especially in Melbourne,
Yes.
There's always due title in the contract.
Oh yeah, if they have like a
Accessories unit, like
garage or
yeah,
something like
and
that.
all the lenders won't accept it, but there are lenders where they'll get a confirmation from solicitors that you can't sell it separately. In those cases, they are accepting those kind of contracts.
There's two different
Yeah, but
titles.
for that specific reason.
And you have
Yeah.
to then get confirmation from a solicitor. That,
Yes.
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 Okay.
But like most of the lenders, they will only it has to be one title.
And do we see the SMSF space changing? Because I remember sitting on training with you once, Ridwan, and you were talking about the value to the government of SMSFs and of super funds. Sorry.
Correct.
So does this pose like people are pulling money out of those super funds that they're now going self-managed?
Yeah.
I mean, is that a tap that the government might want to turn off at one point and say?
Yeah, look, I think it's a really good point that you bring up, and I think it's something that's a realistic prospect. They've been moving the hurdle higher and higher and higher. Before there was no minimums, then there was a minimum.
Yes.
Then post Royal Commission, they brought in the introduction of having financial planners mandatory, help set up self-managed super funds to determine switching and all these other implications. So the short answer is yes. So if we go at the whole sector, and I think it's good for buyers agents to know this, the sector is about $4 trillion, which is larger than some of the Arab countries' sovereign wealth funds with all their stuff, right? So it's a really big pie, right? And a lot of, like, a cat will only sit in front of a pile of food for so long before it reaches out. And so the self-managed super fund space represents a quarter of that, so 25%.
Okay.
So $1.1 trillion is out of the retail super fund's hands.
Mm.
So this is not conspiratorial, this is not anything else but just logic, in the sense that the super fund lobby is very powerful. They help the government with big tier 1 projects, they do a lot of different things, the metros, the rails, they're all funded by the super funds, right? And that's really good for Australia because we have this really good pool of money. But as you start to reduce that from their hands, more and more difficult, loans and objectives and objections come in to be able to make sure that people can correctly handle their own super.
Yes.
And so I think it's a good tool, but I think sometimes, to the point that I was discussing, that it's used politically, right?
Mm.
So I think if you're a buyer's agent, understand the self-managed super fund space really well, understand what their trust is, as Sumit mentioned, custodian trustee, stamping regulations in different states. It's all really complex stuff that we had a buyer's agent, for example, who came in, sent us an email saying, hot deal, need a super fund set up, need the bear trust. It was all just super fast. And I was like, whoa, slow down. This is wrong, this is wrong, this is wrong. And I had another client who was, whose mortgage broker had said, yeah, I know everything about super funds. So I check all the contracts that go. I don't have to, but I do it for the betterment of clients. And they had the super fund's name on the contract for a property which is under loan and all this other stuff. And then the loan contract was in the name of the individuals. And I was like, what is this? And he's like, And so then we ended up having to withdraw from the contract, re-enter it. It was like a really big stressful period, right? So I think in relation to the question is that the super fund space will become more difficult, but that difficulty generally presents opportunity. Align yourself with an accountant, a mortgage broker, or a team that actually understands it, so you can have a really smooth process for the whole thing. Because typically you'll find, and we've gone through that, is that if a client has a really difficult setup and or process in buying that first one, they're like, I'm out.
Yes.
Right?
Yeah. And I've got an experience to share with an external accountant that the client was using. And in the bear trust, how there's an underlying asset? They had the underlying asset as one of the property the client owns under personal name, which was unencumbered. And they're arguing with us for a long period of time, and then it took us a lot of time to explain it to the accountant that this is the actual concept of self-managed super. This is how it works. This is how the document is to look. And it was crazy.
Yeah, look, it is a complex thing, but once you get your head around it, and especially from a buyer's agent's point of view, it's a really good resource because you have a husband and wife team who are investing. They might have 300,000, 400,000, 500,000. That can be, utilizing these products broken up into 3, 4, 5 properties. Have a financial planner involved. Don't be scared with that conversation. Generally, if you align yourself to an advisor who understands your mentality, that they will then support your investment thesis with good critical feedback, right?
Yeah.
So we have some clients who go, I want all properties, no anything else.
No shares.
No shares or no fixed interest. And so sometimes we'll say, okay, great, that's fine, but you have 40,000 left. You can't buy property with it. What are you going to do with it, right? And so those are really helpful conversations. But sometimes, and I think not bad buyers agents, but buyers agents who don't look at their overall pool of what their clients are doing, go, okay, it's just property, yes, number one, but what actually benefits the client, right?
Yeah,
Have a conversation with someone who says, you can buy shares. If the client says no, you've done your job.
Yeah.
Right? You've cleared your angle. So I think definitely understand what custodian arrangements are, why banks are not involved anymore. So the big banks are not involved in super fund lending anymore, even though it's a massive sector, because of the retail lobby, right? The super fund lobby basically said, hey, if you want to do deals with us, you've got to get out of this space, right? That's my personal internal view.
Yeah.
Because they basically turned around overnight and just said, no more loans. I'm not sure if you remember that period. It was really weird. And but now all the small banks, and they have really good products, right? And they're really good, they're really practical.
They have more resources at the moment.
Yeah.
They call it below the line servicing. So let's say if your serviceability is not even utilizing how much you have been contributing towards your super fund, then what they do is they do the assessment under your personal name, how it looks like under your personal name, how much is your income, liabilities, and so on. And let's say your net monthly surplus is 2,000 per month in your personal space, then they will be like, okay, this guy can contribute additional towards the self-managed super fund. So they will take that into consideration for the calculation.
Yeah,
so
that's
they have
really good.
more resources and policies than ever before.
Like for somebody self-employed who hasn't historically been contributing and goes suddenly, hey, wakes up and go, I want to buy and self-managed super fund. That's a really good product, right? Yeah. So I think that's a really good example of how, if you understand the product, does it apply? Now, what are some of the mechanisms that we can do to help the client get there with that long-term view to say, okay, great, it's not just this property at 90, we're going to be making historical contributions going forward. Yeah. And that's useful for the client's tax position.
Yeah, and just to add on to that 90% LVR, the interest rate is relatively high compared to the 80% LVR loans. But the thing is, with self-managed super fund, you can always refinance to for better interest rate. Or you can go back to the same lender and negotiate the rate based on the value of the property has gone up. That means your loan to value ratio has gone down, and they will negotiate those interest rates with you.
Are there liquidity ratios anymore?
There are with few lenders. There are liquidity ratio, but there are lenders where there is no liquidity ratio requirement as well. So few lenders have 5% of the total loan within the self-managed super fund, and few lenders have 10% of your cash management account, how much you have. Yeah.
So it's definitely worth having these conversations with your clients about self-managed super funds. And again, it's not about us as BAs knowing everything and understanding the whole market and knowing all these products that are available. It's aligning yourself with people who understand it and can give that education to your clients. But while there is the opportunity to set up self-managed super funds, probably want to be, at least mentioning it to your clients as a purchasing option.
I had a chat with one of our clients who purchased under self-managed super fund in 2017-18.
Okay.
And at the moment, what they're doing is, because the asset they purchased has grown up so much in value, so they made some around after CZT maybe 400, 500K.
Wow.
And they are offloading that property at the moment because they can't release equity. Not an advice, but that's what they are doing. It's a real life example. And then what they're doing is they are purchasing more asset within that space. So they free up that capital so that they can utilize to purchase more.
To go and do more.
And assuming that works, that if they don't have any serviceability headroom in their personal name, if they were to sell in the super and then rebuy, it doesn't impact.
No, so it doesn't impact anything on
That's really good, right? Because you can start your journey again.
Yeah. And obviously property, when we're buying and selling, it's for the purpose of retiring or having financial freedom. And that super fund is going to give you it's meant to give you financial freedom once you reach retirement age. So it would make sense to hold assets in it that are income producing.
Yeah. And
instead of just letting cash sit there.
Yeah, and one of the comment of that client was, I should have purchased 4 of these, because that would have made 2 million for them, right?
Yeah.
As in, I used to work for an investment banking division of a part of a superannuation team.
Yes.
And so we traded through the GFC. So to your point is that a lot of people had a lot of money in super, and then GFC hit, and it chopped 30, 35, 40% of it. But they're all, like what you actually said is really important, is because they're all capital plays, like they're shares, ultimately, right? So if they had properties, even if they fell in value, they're still producing that cash flow to keep going. So a lot of those clients who are on the cusp of retirement, within 2 to 5 years of retirement, or like, I've got to keep working now because I've got to wait for those shares to come back up, and I've got to continue contributing to make sure it comes back up quick enough for me to retire. But if those assets were cash producing more heavily, then that's good, because a lot of the shares which are invested, they're capital plays, they don't have as much dividend attached. So yeah, that's a really good point.
High risk too.
Yeah. Correct.
Whereas property is a little bit of a safer bet, especially for Australians.
You do love that.
And the other one that we had to discuss was NDIS. I think this is a smaller category. I think there was a lot of people back in 2017, 18, 19. It seemed to be a bigger space that people were playing in. I don't hear it as much these days, but I know that there is lending restrictions around it. That whole NDIS space, there's been, I know recently they started to tighten things up with who they were giving funding to, and it's obviously cost the government a lot of money to support. So what are we seeing in that space? Is that looking like it's starting to taper off as well? Is it a higher risk investment strategy than a standard property?
So from the lending space, we don't have much option.
Okay.
Because what happens is there's an LVR restriction. It can only go up to 80%, can't go higher than that.
Sure.
That's a small problem. The bigger problem is the valuation. So that when the banks does the valuation for those kind of property, because it's a specialist disability accommodation, they require like a bit of a more, I believe, facilities where they can make people's life better.
Sure.
So whenever the banks order the valuation, they look at the comparable sales. And for those kind of properties, they don't have much comparable sales. So the value, based on experience, the value of those properties, the valuation of those properties always come back lower than their actual cost.
Yeah, okay.
So, and the bank only lend 80% LVR, up to 80% LVR, based on the valuation report, not the cost of the property.
Because it's a residential property in a residential area, so you're competing with residential comps, but on a non-standard.
Yes, because
it's essentially a commercial property.
Because the facilities they require is a bit different than the standard property.
So the cost wider doorways. Yeah,
the cost is a bit high compared to like when they order the valuation for comparable sales, they look at the standard property.
Yes.
So that's one issue. The other issue is the rental income that they take into consideration. They base it on the market value, again, market appraisal.
Not what NDIS is going to pay.
Yeah, because they get a bit of a subsidized. So you can get a high cash flow.
Yeah.
But then again, when banks looks at it for your assessment, they look at what the market will take into consideration.
Yeah.
And there aren't much lenders out there. There's only few. Some out there, they don't use brokers at the channel. And I only know one lender at the moment in our space who will do it.
Okay.
But it's very much like if you're planning to refinance, release equity to build up the property portfolio, how are you going to work with that kind of asset is another question.
Yes.
Yeah, it has its own reason and impact what the government is doing, but as an investor, you need to think about what is your goal to. Yeah.
I mean, look, we as accountants, we get a lot of people coming in, whether it's buyers agents, builders, for example, sort of looking in that space. I think from our perspective, it's always something we've said, okay, clients need to sort of measure twice, cut once, because if you are, and it's not to say that you don't, like if buyers agents are working in NDIS, that's fine, but just to make sure that the value that the client's paying stacks up in the event that rents normalize. That's the only challenge that we've ever seen, is that you're paying, you're kind of capitalizing that rent on a cap value which is commercial, at 2, 3, 4, 5, 6%, whatever it might be. It doesn't always translate perfectly. So when we're doing clients who have NDIS providers, we've seen a couple where the actual SDA providers disappear because they go bankrupt or whatever it is.
Yeah. Okay.
And so getting a participant, getting all those things can be challenging. So if you are, from a buyer's agency point of view, working with someone, you just have to have all those guys lined up really perfectly well, so your end client doesn't get stuck with kind of
a property that
just
you
rents
can't
normally.
really rent, or it's going to be harder to rent.
It's harder to tell because they have wider doors.
Yeah,
great
the
handles,
reinforcing. It's almost
yeah.
like a retirement living.
Yeah, so,
like,
so
you know,
sometimes
set up.
can be a challenge, and I think from a valuation perspective, the banks would just normalise it and say, well, as you said, next door and left and right of you is just resi.
Yeah.
So what's that going to look like? And it's not dissimilar to the commercial property space where
Yeah.
you get inflated rents to just flip a property, etc., etc. So there are some challenges that we've seen over the years with that, but there's some good case scenarios where clients have got really good rents for many years, and again it kind of goes back to the fact that because it's a government-driven legislation, how scalable that is from a buyer's point of view is a question.
I mean, they're always going to need housing to some level, but it's what's going to be best for the clients as well.
Absolutely. But yeah, look, I think that type of property can maybe consider a trust because they're usually quite high cash flow. So you can then divert the income. Or
that's where you're getting your tax minimization.
Yeah, exactly right. So, but yeah, interesting space.
What do you guys see for 2026? Like, do you think it's going to be a good year for property?
It's another property advice, but like looking at the market, like there are a few changes. Some of the banks has changed their fixed rate, and so they have increased it a bit, like predicting that there would be an increase in the cash rate or so. But then again,
so predicting like a rate hike.
Yeah, but then again, if you look at the US market, it's saying
they just dropped.
Yeah, it's saying something different. So it's a very mixed signal. We like 99% of our clients are investors, and like in every market that we have navigate their journey, they always want to acquire more assets because they know that will grow in value. And like there will be an acquisition phase, there will be a hold phase, and there will be when they will get benefited out of those properties.
Yes.
So like for us, I don't think there will be any changes. It could be more the issue with the process with lenders, the higher turnaround period, a higher service level, requesting like a lot of documents, a lot of changes in the policies. But our team is pretty much ready. We go through policies every now and then. We have meeting with our BDMs every Tuesday. So we are ready to help our investors in that market. It's just navigating around it. Yeah.
And I guess for us who are dealing with clients, and if they're going through the finance and the purchasing, it's maybe letting them know it could take a little bit longer, like setting those expectations. That obviously coming into Christmas, like what's the current turnaround time frame at the moment for banks?
So some of the banks have like five weeks.
That's a long time.
Yeah, and it's because they are seeing a very high volume of applications.
Sure.
And some of the banks are still seeing somewhere around like 4 days, 5 days.
Okay.
But that might increase, like in next few days.
And that would be like a very vanilla
yes.
client.
Yeah. There are lenders out there who will, like, if it's a very easy loan, they will approve it in like 30 minutes.
Wow. Okay.
30 minutes.
So like first time buyers, it's probably like an easy.
Yeah. They're using AI in the back end just to scan through everything and then approve it.
Wow.
Yeah, that's cool.
Yeah.
So if they're using AI to scan through everything,
yeah,
are they like looking at client spending patterns and things with AI?
Yes. So everything through AI. So they will put all the documents that we have
submitted.
You can't hide. No.
So like secret bank accounts or... Wow.
Yeah.
That's good. There's no random income amounts which bump up your income.
Yeah, that's right. Interesting. Okay. And Rid, what do you think?
Look, from our point, we're governed by two different elements. We see what the tax office pushes out as areas of concern the year ahead, and then also economic factors, RBA and what they do, in amongst talking with all the buyers agents. But what I've always historically seen over the last 15 years is that there's always a buying opportunity.
Yes.
Right? Whether the market goes up, down, sideways or otherwise, good buyers agents, the ones we have on, we work with and we see clients use, there's always buying opportunities. And certainly what we do find is that in times of distress, they're the best buying opportunities, right? So I think in a falling market, your buyer's agent should be calling you all the time. In a rising market, everyone's a buyer's agent. Right?
Yeah.
I'm not saying that in any negative way, but I'm just saying is that if I ran that business in a distressed market is where it would be amazing, right? Because you can see what's going to happen. COVID was a really good example of that. Like, it was this crystal ball that just appeared. You had properties were here yesterday and now they're here.
Yeah.
When this releases and when everything goes back to normal, they're
It
going
just
to be
went.
here,
Yeah.
right? And so, you know, some of the bigger players, Invest and a few others, they were saying this is the time to buy.
Yeah.
It's a really good opportunity. So I think, you know, if you take the lending world, they only make money when they lend money.
That's
So
right.
they will also look for ways in which to make sure that
Yeah, they have. That's their business.
That's their
So
business,
they
right?
have to always
Yeah,
lend
so
money.
no one's sitting around going, oh, okay, well, the property markets will pull back a little bit. That's all they do. So I think if you've got a good team around you and you can have that, like that strength in the fact that you know what you're buying, as opposed to buying a transactional deal, and why you're buying into this asset class, I think it's 2026 should be a good year. Personally, I think it would be a good year, and I think the RBA has learnt a lot over the last 4 years, which is they didn't do a lot of jaw burning, right? Jaw burning meaning that you get the market to talk about a rate rise, so then all the common people like us go, oh my God, there's a rate rise coming, but it never comes.
Yeah.
And so as a buyer's agent or a business owner investing in property, you need to learn that type of mechanism that the government is using to be able to try and ensure that the property market goes up at the right rate. It doesn't go up exponentially, hockey stick doesn't work, and then obviously the reverse side of it is. So the APRA legislation changes, for me, wasn't very special, because like, you've done this before.
Yeah, they've done it before. That's
Right?
exactly
So
right.
I think if you're a good buyer's agent, you go, okay, cool, I know what's going to come.
Yeah, that's right.
Yeah.
And it was okay. We all made it through
Yeah.
2017 to 2019.
So yeah, I
And
think
with lenders as well, right? Like some of the non-bank lenders, they're funded in the back end by the big lenders.
Yeah, that's
Yeah.
exactly right.
Yeah, so they need to make money at the end of the day, and then they make money when they lend more money
Yeah.
to people, and there's a repayment of those loans. So they are still going to go ahead with a lot of those non-lenders, and non-bank lenders have been like amazing in the last couple of years, like more resources, more policies, like serviceability is good, the interest rate is, some lenders have decent, like very competitive to first year lenders, some have a bit of expensive, but then again, that's a solution for you. If you want to acquire more assets, that could be a solution for the time being anyway. At the end of the day, like loan contract is for 30 years, but if your financial circumstances change it in a positive way, and if you can refinance to a better lender for a better interest rate, then that could be a solution you're looking for.
we find them to be a
That's
little
right.
bit more
Yeah.
bespoke. Like I think Suma and other teams that we work with, they'll actually go to the private lenders and say, hey, this is the circumstance. Is there room here? And because they're smaller outfit, right, they actually can engage with that process well. So
Yeah,
if you're not aligned to a broker who's dealing with, a number of the non-bank
The smaller
lenders, I
lenders,
think it's
yeah.
a useful exercise to get in touch with someone.
yeah, 100%. Well, thank you guys. I'm just going to see if we've had any questions come through. I don't believe so. So now would be the time if you would like to ask any questions. Otherwise, we are going to jump off, and we'll leave your details, Suma and Ridwan. So if anyone wants to get in touch with you or have their clients in touch, you can help them out.
Amazing. Thank you for having us.
Thank you,
Thank
guys.
you.